My first guess says, okay, she remains a buyer of equities on dips and bonds just to lock in these peak interest rates. Joining me now, UBS Private Wealth Management Managing Director Alli McCartney. Alli,
hi.
How you been?
Good.
You want to go back here?
I want to talk about this because you and I are big what happened in history and looking at the data. The other thing that points to an above average year, and remember an average S&P year is 9.5, is an election year. We tend to have outperformance in election years irrespective. We're now about 6 months out. And so I think thematically, although you have some contrarianism in the pessimism you're seeing, that we still can expect both volatility and expansion.
Because of all the money that pours into the economy? Is that sort of, I mean, why election years?
I think, this is just my conjecture,
right.
I think that people want to make it into something bigger than it is, and so they hold off for a bit, and you see some of this volatility and buyer's strike, and then you see people go in when they get more comfortable and they have some result.
Let's talk about earnings right now, because these are technology earnings, the XLK, right? The S&P 500 tech names. Companies that beat the street, they've gone down. Companies that missed have gotten crushed, right? So is this really when you get into a place where maybe stocks are priced for perfection, at least on a short-term basis?
Well, I think that certain stocks are priced for perfection, and largely it's the universe that you've been showing, right? So I think that what you're seeing is there are a lot of stocks outside of big tech and AI that have done very well. U.S. housing stocks, industrial stocks, healthcare stocks. And so I think what we're looking at is that individual data and expectations matter, but overall, we're beating by a wider margin, 8%, than we usually do at 4%.
I'm from the school that I like when the street is pessimistic or not looking. You know, like when I see this, right, the earnings expectations going into the fourth quarter, I mean, golly, that's huge. I would have preferred to see it there, right, because it's an easier hurdle to jump. Could something like this be a headwind for the market?
It could, if we get too far out over our skis. But I think when you actually look at valuations, if you take the average valuation, right? If you say that we're trading at, you know, apart from tech, which is probably closer to 25, if you say that the market's trading at or just above historicals, well, okay, so that makes you think that there's some room for, you know, moderation or correction. I'm thinking about it a different way, which is history, although it's useful, has never had 15 years of free money and global monetary expansion. So maybe that is not priced for perfection. Maybe there actually is some more upside. So if you can get in at 5,000, right, and have a couple of great days where the narratives on the Fed and earnings come together, then there is money to be made.
So last month, the ETF flows are pretty simple. Cash and growth. That's where it was, right? I mean, that's what's working. You get a nice yield, and then you've been getting paid pretty well if you own growth stocks. On the other end of the equation, massive outflows in small caps. Is this something that people should, I mean, I know you like to be positioned, right? You're not really a chaser per se.
No.
Someone looking at making money in the market, you wouldn't go with this strategy, would you?
I wouldn't, and I'll tell you why. Let's look at the two here, right? So small cap equity, we've talked about this a lot. Been a huge beneficiary of the last 3 risk-on days where yields have backed off. That has to be part of a portfolio.
Yields go down, that's really good for small caps.
Right. Investment grade and high yield, we don't need to trade in and out of it. If we know that we're getting 5, 6, 7%, and we can put it, for example, in a tax-advantaged account and keep that, we don't need to worry about the mark-to-market of daily interest rate volatility. So I do believe in all those, but I also believe that positioning makes sense for me, given the level of comfort that has come in from the Fed and via job market data. Before
I let you go, though, you do see increased volatility, earnings reactions, which we're already seeing. Again, Disney, Palantir today, geopolitical escalation, the U.S. election we've kind of touched on, and Fed policy interest rates, which have, there's still something of a coin toss, at least near term. No one can pinpoint where this is going.
Let me say one quick thing, because I know I'm out of time. So I think the most important point here is that inflation has been going the direction that we wanted. But I think a lot of these things feed into the biggest risk here, which is that oil gets more precious and starts to color going forward, because of geopolitical risk and U.S. election risk, that we start to sort of color CPI, and that changes a lot of this.
All right. Great stuff. Love that dress, by the way.
Thank you.